welcome to the January 2024 Buy-to-Let Mortgage Market Update. My name's Richard Purnell. I'm from The Mortgage Home and we are your buy-to-let mortgage experts. In this update, I've got 4 topics I want to cover off. First of all, I'm going to do my Mystic Meg impressions. If you're of a certain age, you'll know exactly who she is. It's my predictions for 2024. What do I think is going to happen both with the Bank of England rate as well as mortgage rates, so stay tuned for that. Now, I've been focusing in because we have a lot of watchers that are either already landlords with holiday lets or they aspire to get holiday lets in 2024. So I focused in on what looks to me to be right now one of the best 5-year fixed deals for a holiday let mortgage out there. So I want to just get under the surface of that, talk through some of the features and benefits of that particular product and who might be eligible for it. So stay tuned for that if you're interested in holiday lets. Now, limited companies. I saw a survey in the last few days that said that in 2024, 2 out of every 3 purchases would be within a limited company. It's the biggest statistic I've ever seen in this area. So if that's you, are you thinking of getting a buy-to-let within a limited company for the first time? Are you just about setting them up, or you already got them set up and are you wondering, have I done it right? Well, here's my take in this section on how to set up the optimum type of limited company that's going to be accepted by the majority of lenders, which is at the end of the day what we want. And then on my final piece, I want to talk, I always try and put a piece in about how to save money, and this is builders insurance. Maybe not the sexiest topic, but man, it's a serious topic, particularly if ever you need to make a claim. You want to make sure you've got that right. But also, can we get not only the right quality of product, but can we save you some money? So if you're interested in maybe reviewing that, seeing how you might be able to save some money on your builder's insurance, stay tuned for that piece. So let's get straight into it. What's my predictions for this year, 2024? Well, at the time of recording this, I'm recording this on the 8th of January. And over the last few days, we've had many of the large building societies and banks absolutely slash mortgage rates. And it's really come as a shock, I think, to the markets, to us as brokers, that we've started the year with slashing and burning the interest rates on mortgages. Actually, that's going to make predictions due to this sort of short-term, really positive, really welcome volatility, but volatility it is. So it's going to make the predictions a little bit more challenging. But here we go. So I'm going to start with the Bank of England. Now, as I've said on my top bullet point here, I think it has sort of topped out. I don't think that's it takes Einstein to work that one out. We've had 3 months now of stability. And I've used the stability word quite a lot on my recent presentations, and it's the markets love, and they've lapped it up because it allows more certainty for them predicting what's going to happen. And so the 5.25% rate that the Bank of England have right now, I don't see that increase any further. So I think that's an easy soft start for me to predict that. But if you're expecting, then there's a lot of headlines and there's quite a clamour for the Bank of England to actually drop rates, then I think we've got some time to wait here. So stability for the next, certainly 2 quarters, possibly into right through to September of 2024. I do not see any rate reductions from the Bank of England perspective. So only when we get into the back end of the year, possibly Q3, definitely by Q4, then we'll start to see the Bank of England start to cut the Bank of England rate. And as I've said on my headline piece here, 3rd bullet point down, I reckon by the end of the year, we'll finish with either a 1/4 or a 0.5% reduction. The reason I don't see Bank of England dropping rates right now is that inflation is going really well, by the way. It's dropping at a rate actually quicker than the Bank of England had budgeted and therefore predicted. So that's the good news, which is why the Bank of England have taken their foot off the gas and stopped the incremental increases in rates. But it's easier, relatively speaking, to go from over 10% inflation, which is where we were about 6, 7, 8 months ago, down to the 3.9% we're at now. But it's that last 2%. To get from 3.9 down to 2% is a lot harder. So if we keep an eye on that, I think it could be another 6 months before inflation is down close to that 2% figure. And it's only when we're getting close to that figure that I see that being a trigger for the Bank of England dropping their own rates. So we keep an eye on that, but that's my view. Now, what does that mean then for mortgage rates? Because as I said at the head of this piece, the banks and building societies are absolutely having a January sale on mortgages, which is fantastic news. But here's the thing. It's a tale of two halves. Now, the halves are the banks and building societies on one hand and the secondary lenders on the other hand. A secondary lender, for those that have not heard this description before, is any institution or organisation that lends for mortgages, but they are not a bank or a building society. So, to give you some examples, we've got Fleet Mortgages, Foundation Mortgages, Kensington, Kent Reliance, Precise, TML, Lendinvest. To give a few examples, these are lenders that only lend on mortgages. So here's the important thing. When we've seen the brilliant headlines from your HSBCs and your Halifaxes over the weekend, cutting rates by up to 1%, these are multinational, multi-billion-dollar turnover institutions who have got fingers in a wide variety of pies. Therefore, if they choose to slash rates on their mortgage products, what they're actually saying is we are comfortable in not making a profit on our mortgage side, but we're making profits everywhere else. So they can take that view. So what these big institutions have decided on for 2024 is to go for market share at the expense of profit. And they can do that for the reasons I've said and still keep the shareholders satisfied. Go to your secondary lenders. They're a one-trick pony. All they've got are mortgages to sell. So yes, they can cut their margins a little, as we've seen at the back end of last year, with rates getting marginally better. But they can't continue to do that, and they can't compete with your HSBCs. So these secondary lenders still have to make a profit. So therefore, my prediction is that yes, if you are a landlord who can still knock on the door of the high street banks and building societies, in other words, generally speaking, you are a non-portfolio landlord, my apologies. In other words, you've got 4 properties or less, then you'll see the benefit this year, and right now, in fact, of cheaper rates. If you're a portfolio landlord, that's 4 and more properties in the background, then there's a grey area, 4 to 10, you get some high street banks and building societies that will still lend to you. As soon as you get above 10 buy-to-lets in the background, every high street will shut their door on you, and you only have the secondary lenders to go to. So if you've got more than 10 properties, you are not going to see any rates cutting for, again, 6 to 9 months of this year is my prediction. So as we get towards the end of 2024, if you had a portfolio landlord with a significant portfolio of certainly above 10 properties, then what you're seeing now is what you're going to get. So from a decision-making point of view, don't be sat on your hands anymore. The rates that your broker's talking to you about is pretty much the rates you're going to see for half, if not 3/4 of this year. So you can make your decision with some certainty. And it's only as we get towards the back end of the year, mirroring when the Bank of England is going to start to drop their their Bank of England rate, because the secondary lenders will be able to get their wholesale money a little bit cheaper, without getting into detail today of that connection with the Bank of England rate, but there is a connection. So I can then see that the secondary lenders will pass on the benefit of cheaper wholesale borrowing and pass that through to you in cheaper rates, but not until the end of this year. And just a final comment, the end of the year is an artificial line in the sand, isn't it? Even though we're talking about 2024. I see it then continuing, certainly with the Bank of England. I see rates dropping into 2025, by the way. And possibly in 2025, it gets a bit fuzzier, doesn't it, the further ahead we look at. But another 0.5 to 1% cut on interest rates into 2025. So the medium-term view is that rates will continue to drop further. But the good news, to summarize all this, is that rates are going to be dropping sooner than I was predicting probably 3 months ago. And that's really all down to inflation dropping at a quicker pace. So hopefully that's been of use to you, gives you a little bit more certainty, allows you to plan for 2024. And that's my predictions for this year. In this piece, I want to talk about holiday lets. I want to put a bit of a spotlight on a certain mortgage product. So we have a lot of viewers who are looking to get into holiday lets in 2024. It's going to make them more profit, more money compared to the traditional buy-to-lets. We've got a lot of our landlords that have already made that transition into the holiday let sort of market. So I thought I would take a look at what looks to be around the top of the table in terms of a 5-year deal for a holiday let mortgage right now. Now, look, you will see there'll be some great headlines with rates cheaper than 5.94%. But be wary of the arrangement fees, because look at my second bullet point. This has got an arrangement fee of $9.99. It's about as cheap as an arrangement fee you're going to get. It's quite commonplace nowadays for lenders to offer some incredibly cheap headline grabbing interest rate, but then when you look at the arrangement fees that are being charged, can be anything up to an additional 7% of the borrowing. So if you've got a 200 grand mortgage, that's £14,000 extra fee you're going to have to pay. Massive, and all of a sudden it's not as competitive as you thought. So this is a really nice blend. 5.94 is a really solid rate. That's 75% borrowing as well, which is pretty much the highest level of borrowing you're going to get. It's got that really nice, relatively cheap arrangement fee. And here's the thing. If you're doing a remortgage, it comes with a free valuation and free legals as well. So, happy days, extra savings for you. I mean, that could be in excess of £1,000 worth of savings, maybe £1,500 when you talk about solicitor costs and paying for a valuation fee. So nice to have, certainly. Now, here's something from a policy point of view on this particular product. The policy says there's no maximum bedrooms. Now, there's a bit of a cautionary word here of advice, because I know as an experienced broker in this area that the bigger the number of bedrooms you go, the more nervous the lender or the underwriter is going to be. So if you are coming to this lender with a 5 or maybe a 6 bedroom property, you probably, in a decent area that's good for tourists, would work well as a holiday let, then I think all day long you should be okay. Once you're getting above that 6 bedroom figure to 7 to 8 to 9 bedrooms, that's where we need a lot of information up front. We need to speak to the lender, the underwriter, to get a feel for whether that's likely to be accepted. In reality, if the property you're looking to use as a holiday let was in the past a bed and breakfast or a care home or a guest house, something of that nature, I'd be surprised if this lender will take that type of property on board. But they do say that there's no maximum bedroom, so it's worth asking the question, really, if you've got one of those larger properties. You can borrow up to £500,000, which, frankly, covers pretty much everybody. Now, here's another positive here. Low, medium, and high. What I mean here is, how do they work out how you can borrow the money? Because lenders use depending on which lender you go to for a holiday let mortgage, there's two camps. If you're not at this one, you might want to jot this one down. There's two ways that lenders can calculate how much they're going to lend you when it's a holiday let. There's a very safe and prudent way from a lender's point of view. And then there's a more aggressive way, more flexible way that means that you are likely to be able to borrow more money. So where you're getting a larger holiday let, you really want to be leaning to those lenders that work on a low, medium and high. And this product is exactly on that sort of basis. So really pleased to see that this lender, if you're going to lend on a holiday let, will look at those weekly, seasonal predictions on what you're likely to get in as gross holiday let revenue across a low season and the mid season and then the high season. And then they do some calculations from there. And nearly always you'll get more borrowing compared to this more prudent method. And by the way, the prudent method, just to maybe finish off that conversation, is yes, they'll lend the money to you to use as a holiday let, but these more prudent lenders say, but the rent figure we use is not the holiday let projections, it's what that property would rent out at as if it was just a normal family let, a normal AST, assured short hold tenancy basis, which clearly is going to be a smaller figure. So if you're getting a smaller end property, it probably doesn't matter too much. But if you're getting a larger property, and if you can borrow up to $500,000 at 75%, then you're buying at 670, pushing 700,000 as a purchase price. You definitely want a lender that uses the low, medium and high, and this one does. And so that's a big tick in the box. I applaud that lender for taking that approach. And here's another thing. It can be a brand new holiday. So it doesn't have to have any sort of track record of being a holiday let. So you might think, well, from a lender's point of view, surely that's a bit more of a risk. Is it going to work? Is it in the right area? If there's no track record that people are going to book this holiday let, you could, there are some lenders that want to see a track record, but this one doesn't. Brilliant. Great. They're going to back you if it's in the right area. It looks and smells and feels like it should work as a holiday let, even though there's no track record. Then they're still going to back it and they'll say they will lend on this type of property. Even if you're going to use it for Airbnb. And what I mean by that is that you're not giving it to an agent to manage. Let's say you're going to manage it yourself. You're going to put it on Airbnb or Booking.com and self-manage. There are some picky lenders out there that if you're going to self-manage will not lend to you. So be mindful of that when you're talking to your broker about giving them that information. If they're a decent broker who understands about holiday let lenders and their requirements, they will be asking you down to that detail, how are you going to manage the property? Are you doing it yourself? Are you giving it to an agent? But again, this lender doesn't care. So really happy days. Again, applaud the lender for that. But in brackets, not SA, not serviced accommodation. So what do I mean by that? Is that if you're going to use this property, yes, to let on a short-term basis for short-term bookings, but the guest is more likely to be a worker, more likely to be a contractor, a tradesperson, a professional who's coming into an area to work through the week, then this lender is not looking for that type of business. And you might say, well, how would the lender know? Well, depends on the location, I would say. It's not that always easy to find out, but if you're looking to buy a property that's not in a traditional tourist holiday area, and it is in a more of a commercial area, there's your clue. And you could find that the underwriter is going to decline the case. And the final comment on here, and this reflects that this product is offered by a building society, is that they tend to be more cautious in nature, the banks and building societies, and they tend to want as business smaller landlords. So if you have more than 3 properties in your portfolio, this isn't for you. There are other lenders, of course, that have lots of appetite to lend to you when you've got 4 and 5 and 10 and 20 and 50 properties. But with this particular lender, probably really because it's a building society, that they're not looking for portfolio landlords, not the serious professional landlords. It's the landlord that maybe has another job and is just starting to build a portfolio up. Then up to 3 in the portfolio is fine. But if you're purchasing number 4, or even, watch out for this one, you're remortgaging number 3, but you're pulling money out to buy number 4, you could end up getting declined as well on that point. So bear that one in mind. But look, if I'm talking to you, if that is of interest to you, if you're looking to start to plan to get your holiday lets for this year, this gives you an idea of the sort of rates that are out there right now. If you listen to my prediction section, then I don't see these rates dropping much, particularly if you are a portfolio landlord, although we might see some drops over the next week or two from the building societies. So on this one, we might actually see the rates dropping a little bit over the next week or two. I would not be surprised. So happy days on that one. And if you do want to have a chat a little bit more to us about what's out there, do I fit? Maybe you are a portfolio landlord and you're thinking of getting into holiday lets. What would those look like then? There'll be a link to our diary at the end of this piece, and just book some time on. Look, there's no obligation, no commitment. Bit of your time, bit of our time, and we'll give you our expert opinion, and that will help you to make decisions, and that's what it's about. In this piece, I want to talk about limited company setups. Now, I saw a survey in the last week that said that 2 out of 3 purchases of buy-to-lets in 2024 will be done in a limited company. Now, that's the highest ratio I have ever seen. It's been on the rise for about 6 or 7 years now, really slowly, incrementally, more landlords getting their heads around limited companies. Certainly as the tax challenges rise, we're on a certain path now with landlords, a well-trodden path, I would say. But what I'm seeing is that there's even more landlords still jumping on the bandwagon of getting limited companies. Probably late to the party, I would say. However, that rise is continuing. 2 out of 3 applications in 2024 in a limited company. So I thought it'd be really useful, really important to our watchers, for those who are thinking about getting into limited company for the first time, just about setting them up. Maybe they've set them up and they're just pausing them in the background because they've not actually bought anything just yet. Have you set it up correctly? Is it correct? Because here's the thing. In one ear, you've got your tax accountant advising you how to set your limited company up to get the most tax efficient setup. And I get that. That's why you're doing it. However, what is massively important is if that setup is too complex, lenders won't lend to you. So what's the point in having a tax efficient limited company that you can't use? So it's getting that balance, that compromise where you're maximizing the tax saving on one side, and on the other side, you're getting a limited company that most lenders have appetite to lend to. And that's where the balance is. And that's what I want to talk about today. So get your pens and papers out if you're interested in getting limited companies, and jot some of the things I'm about to tell you now, and you can check to make sure your limited company is set up that way. Or if you're about to set it up, you know in more detail how to set it up. And of course, you can always chat to us afterwards. As I always say, look, there's a link at the end. It's not always about business. For us right now, if we can help you today, hopefully that creates a little bit of a relationship and you'll think of us in the future. So if you want then to talk to us in more detail about limited companies and how it might affect lending for your circumstances, again, book some time in. Now, first thing I want to say about limited companies is there's 2 categories of limited company: trading limited companies and SPV. Bit of jargon, stands for special purpose vehicle. It's no more than a limited company that's set up purely to hold buy-to-let properties. That's all it means, nothing more than that. Let's start with trading companies. if you are listening to this and you already have a limited company for your trading business. Now, what do I mean by trading business? Are you a plumber? Are you an IT consultant with a limited company? And your earned income goes into that company, that's a trading company. If your earned income goes into it, and that's not rental income is not earned income. You might think I'm working hard, but the Inland Revenue class it as unearned income, meaning you haven't physically put effort in. Yeah, we can argue all day long that we put effort in, but we don't have a job in the traditional sense. So earned income going into a limited company is then classed as a trading company. And I would say roughly anecdotally 2 out of 3 lenders that would lend to a limited company would not lend to a trading company. So you might think, well, I'll save a bit of money and time and effort because I've already got a trading limited company. I'll just get my buy-to-lets in that as well. Yes, you can do that, but you are severely restricting the number of lenders that we can go to. So in my generic opinion, this isn't advice, but generically, I would say it's usually better to start afresh, set up an SPV to hold the buy-to-lets in going forward. And then you'll find that every single lender is potentially going to lend to that brand new limited company. What I've seen on the rise in the last year or so are things called family investment companies. And I've seen a lot of tax accountants set up propositions to say, come to us and we'll set you up this fancy, what they call a family investment company with alphabet shares, and it's massively tax efficient. My view is that as long as we're not making it too complicated, talk to us if you're thinking of going down that route. Yes, we've lenders that are comfortable with using alphabet shares. There might be a little bit of restriction, but within certain parameters, certain limitations you need to be aware of when you're setting up alphabet shares and putting either kids on as part of the shareholding. Then there are certain things that you must know about. So if you're thinking of setting one of these up and you're talking to one of these specialist companies now, speak to your broker at the same time so you get that compromise, because too many times I've got landlords coming to us, they've already set up the family investment company, and then you have to go back and amend them, and it's costing more time, more money, and delays things. So talk to us now if that's you, if you're thinking of doing that. Layered companies, again, it's around the complexity of the company. Subsidiaries with parent companies, that's what I'm talking about here. Again, the devil's in the detail. There's a reasonable number of lenders that are quite comfortable with lending to a subsidiary company, but the shares of that subsidiary company are not owned in your personal name, they're owned by yet another company. So it's understanding the detail, the directorships, the shareholding of both companies in simplistic terms, and these things are not all simple, and again, it's why you need to talk to us. But if the shareholding, if the directors are mirrored across the two companies, then that's certainly what lenders are looking for. If the directors are quite different in the parent company to the subsidiary, that's where you're going to have more issues and restrictions and appetite to lend. So again, if you're thinking of setting that sort of more complex structure up, then again, talk to us at the same time. Get our pragmatic view as well as the tax accountant view, and let's get to a workable solution for you going forward. Finally, it's around the introduction of capital. Where does the money come from into the limited company? Again, so let me go back to the point about your trading company. Let's say you are an IT contractor and you've made profits. You don't need to take them out of the company because you're going to get taxed on a personal basis. So the money's built up there as retained profit within that limited company. And you want to use that now as deposits on your purchase. Well, using intercompany loans, moving that money from one company into the new SPV is one way as an intercompany loan. Or you can pull the money out as an individual and then introduce it as a director's loan and again, you would need to speak to the accountant about which would work best for you. That we are getting into tax advice, but from a lender point of view, both methods are globally acceptable, really, by pretty much every lender. So the challenge comes, and again, if is where you've got JV partners, joint venture partners, wanting to give you some money to introduce the capital in. Then I've look back on some of my previous updates. I've done detailed pieces on joint venture partners and how to introduce money into that. It's quite complex, needs a lot of preparation, and I would definitely make a note to speak to the team if you're looking to set up a limited company with a joint venture. It's a big topic in itself. I'm not going to cover it off today. Have covered it off previously, or click on the link at the end of this piece and speak to the team if the introduction of capital is coming from a JV partner. Hopefully that's been of use to you today. And as I said, if you want to chat it further, then put some time to speak to the team. In this piece, I want to talk about portfolio insurance. What do I mean by that? Well, essentially, it's building insurance. Possibly not the most sexiest of topics. However, massively important topic, particularly for those of us that have had a claim in the past. And if that claim's ever been argued, negotiated, rejected, then it's a hugely important topic. And therefore, I want to cover that off today. And if you are wanting to get the right balance, get the right quality of insurance, and possibly save some money, then you must listen to this piece. So if you are a landlord that renews their buildings insurance on a property by property basis, just does one insurance policy for one property, then straight away, as a portfolio landlord, you are missing out on a trick here, because there is this thing called portfolio insurance, where if you approach the insurer with all your portfolio or multiple properties, you've got discounts to be had. So if you're not taking advantage of that already, then straight away make a note, write this down to give us a ring at the end of this piece, jump on the online diary, book some time in, and we will have a review of your insurance. And hopefully, if nothing else, we can get you the same quality of cover and actually save you some money. Who doesn't want that? So, things to look out for. De facto ratings. Now, we've all been on holiday to hotels that have got a 3-star rating, a 4-star, 5-star rating. It's exactly the same as that. So, but it's got this fancy name called de facto. 5-star is the highest, and in my opinion, is the rating that you should have for your buy-to-let properties. So again, jot this down. Have a look afterwards. Dust off that policy. What star rating is. If you've got your policies off comparison sites in the past, then that's all about price. It tends to give you a league table based on cheapest premium. And the cheapest premiums are, if you do that on booking.com, your 3-star properties will come out the top, won't they? They're the cheapest. But do you want to stay there? Well, it's questionable, isn't it? So it's the same with insurance. Be mindful of your cheap quotations. So is your policy a 4-star or a 5-star de facto rated property? You should be getting 5-star, in my opinion. And I'm going to give you some examples shortly. Again, you might want to jot this down to understand what the difference between 4 and 5-star might be. Now, one of the things that I would look for is emergency call-out cover. As a landlord myself, the sort of phone calls I get, or via the agent, are things like, the boiler's stopped working, the boiler's broken down, we've got a problem with the pipe work, maybe the water's not working properly, or we've got a leak, or the drainage isn't working. Something of that nature, or there's issues with the locks, the key's broken in the lock, or I just can't get in the house, the lock's just given up completely. And do these calls happen at 10 a.m? No, they don't, do they? They happen at 10 o'clock at night. Of course they do. So with these policies, you've got 24/7 call out, 365 days a year. You make one phone call to one number for any trade, and the insurance company then will deal with it. They'll send out the tradesperson to deal with that issue. So peace of mind for you as a landlord. And because I would say that's one of the biggest outlays as a landlord, that general maintenance stuff when it comes to the sort of things that I've just mentioned. So if you can get those included in your insurance policy, massive savings, because it's going to reduce your maintenance costs. Rent guarantee. Look, when you've been a landlord for a number of years, eventually there'll be a tenant that doesn't pay. It's a fact. So if you can build into your insurance policy a rent guarantee that says if your tenant gets into arrears, we will start paying your rent, then that's a brilliant benefit to have. Now, just to give you an idea, they'll pay out for a further 6 months. So your tenant's got into arrears by 2 months. That's usually the trigger. The rent guarantee kicks in for a further 6 months. And that gives you the breathing space to say, right, how do I deal with this tenant? You'll see on the next bullet point, legal protection. They actually go hand in glove. If you've got rent guarantee included in your policy, you will also have legal protection. The insurer will insist on it because it may well be you've got to engage with a solicitor to get those arrears back paid off. And it might require, great if it's just a few phone calls, but if you're 2 months in arrears, it's getting quite serious, isn't it? It's not just a few days late. With 2 months in arrears, so you're probably going to need some legal backing to sort out those arrears. Or if the worst case happens, how do you get the tenant out of your property? Either way, legal redress may be required, in some cases even going through the courts. So the costs of all that redress is taken care of with the insurance policy if you've got the rent guarantee part of things. Now, here's an important thing about trace and access. If you've not heard about this, the best way to describe it is for me to give you my own example, my own story that happened to me only about 2 years ago. I got a leak and knew there was a leak because in my utility room, the floors are tiled and the grouting had gone a really dark colour and it was sort of damp to the touch. You knew something was wrong. And I knew there was pipes under the tiles. So sadly, we had to chip into the tiles, lift a few tiles up, and it was quite obvious then underneath that the floor was wet. So we had a bigger issue. So to get to the point of the part of the pipe where the leak was, the tiles had to come up. The tiles went under a kitchen in the utility room, so the kitchen had to come out. Once all the tiles were up, then you've got the wooden flooring has to come up, and eventually you've got access to the pipe work. The pipe itself was just a little hairline crack, and the pipe was actually fixed in about an hour. But of course, guess what? The invoice, I would say 90% of the cost and the time and the effort is removing a kitchen, upping the tiles, sorting out the flooring, and only 10% of the time and the cost is actually repairing the leak. Now, here's the thing you really need to check. Because in the 4-star rated or the lower quality type of insurance, trace and access is not included. So in my example, in my story, if I hadn't have had that included, I would have had to pay that trades guy to remove a whole kitchen. You can imagine, and they have to do it carefully because they don't want to, no one wants to then have to put a brand new kitchen in. So can you take a kitchen out really carefully in one piece with very little to no damage? Quite often you've got tiling along the back, so you're going to damage some tiles as a very minimum. So all that effort will be at the expense of you as a landlord, taking the tiles up, the flooring up, and only once you've exposed the pipe leak would that be covered by the insurance. And, you know, it's not all landlords know about this trace and access. So again, that higher quality cover absolutely pays for itself in the example I've just given you. You know, I was delighted that the fact that I'm aware that that is something that's important to have included. Another thing that you'll find in 5-star rated properties, insurance policies, is something called unoccupied property cover. What insurers really don't like is an empty. Look, we don't like empty properties, do we? Because we're not getting an income stream. Insurers don't like empty properties because it's more likely they're going to get broken into, or if it's empty, if there is a leak, it's not going to get spotted for longer. It's going to cause more damage. So insurers do not like empty properties. So you may not be aware of this, but they will have a maximum period of which that insurance would still be valid before eventually the insurer says, we're not covering you anymore. Now, 60 days is what you're looking for. The cheaper policies will do a 30-day unoccupied property cover. So again, if you're unsure, dust off the policy, have a look, see what you've got. That'll be another clue that it's a lower quality policy. You want the 60-day cover. And just to finish off on that particular piece, beyond 60 days, does that mean you have no cover whatsoever? If, let's say, you're in between tenants or you bought a property and you're doing some work to it, and it's going to take longer than 60 days to not only get the property up to scratch, but then to advertise and get a tenant in, does that mean you've got no cover whatsoever? No, it doesn't, but it does default to a basic type of cover, a more diluted version than the full cover that you would have when your tenant's in place. And that's across the board with all properties. So be really mindful of that. And actually, if you're actually buying a property that's, let's say, a project property, it's going to take you months to get the property renovated, then actually you want a different type of policy altogether, insurance. The normal buildings insurance policy for occupied properties is not relevant. It's not fit for purpose. If you've got a project property, you should have something slightly different whilst you're in project mode, and then that gets cancelled and replaced by the normal occupied buildings insurance. So please bear that in mind as a landlord if you've got any project type properties. I really hope that's been of use. You've made some notes. And if you want to speak to us about your existing policy, can you get it cheaper for the same quality? Maybe we can get better quality and it doesn't cost you any more. Then we'd be delighted to have a look at your existing policy, give you some feedback on it, and whether you can improve, and like I say, the quality of cover, or indeed save a bit of money. So if so, click on the link, book some time in, and let's see if we can help. And just to finish with, here's our slide on that link through to our online diary and booking system. We have evening slots right through Monday through to Friday, as well as the daytime slots. If there's any slots that you're looking for that are not on the diary, just give the office a call. Look, we're really flexible. We'll do what we can. If you're only around even on a weekend, we'll do our best to speak to you on a weekend if you're working away, for example, or there's some urgent issue that means that you need to speak to someone and there doesn't seem to be any availability. Just give the office a call and we'll absolutely bend over backwards to help you out. And really finally, that's a listing of the services that we offer, starting off with the insurances at the top, right through to the different types of finance, whether it's short-term with bridging, or flipping properties, whether it's getting commercial, semi-commercial, buy-to-lets, holiday-lets, and everything in between. We'll be delighted to help. If you've enjoyed this and stuck it to the end, then really appreciate your attention. Do click on the like and subscribe. It really helps us to increase the profile. The more people we get on, the more we're likely to put content and keep this going. And give us your feedback. If there's topics you want us to cover later on in this year, then just put it into the comments and I'll do my best to cover off those topics later on. Other than that, thank you so much for listening and watching today, and have a great rest of the month, and we'll see you on the next update.